All right, so Pampa Energia just dropped their Q3 earnings. And the stock? Yeah, it kind of slipped. But here's the thing. If you only look at that headline reaction, you are missing a story of absolutely explosive growth happening just beneath the surface. And in this Talk Tickers briefing, we're going to dig in and show you exactly what everyone else seems to be overlooking. Okay, so this quarter from Pampa is like the classic financial iceberg. What you see on the surface, the part that everyone reacted to, was this big, flashy miss on earnings per share. And that spoke to some people for sure. But then you look under the water at the actual operations, and you see this powerful engine just churning out growth. It's this exact kind of disconnect, this hidden story, that can create some really interesting opportunities. So here's the game plan for today. We'll start by digging into that whole optics versus operations thing. Then, we'll look inside the growth engine itself. After that, we'll cover what management is saying about the future. And finally, we'll wrap up with our view on the next call and a potential trade idea.
All right, Section 1, Earnings, Optics versus Operations. So what's really going on here? Why the disconnect between that headline miss and the core strength? Well, believe it or not, it all comes down to one single, kind of misleading number. Let's get into the data.
So check this out. That top line, the GAAP EPS, 40 cents versus an expected 73. That's a big miss, and that's what the headlines all jumped on. But then, you look just below that. Revenue, a nice little beat. And then the big one, adjusted EBITDA, which really tells you how the core business is doing, up a whopping 16% year over year. So you've got this huge split. What on earth is causing that? Well, here's your answer. The entire miss was caused by this one thing, a non-cash deferred tax charge. Now, that sounds complicated, but here's all you need to know. It's basically just an accounting rule. It's a paper loss that has to do with some quirks in Argentina's economy. It did not impact the company's cash flow one bit. Not a single dollar of real money left the building. Management even said it's a one-off thing. It's just accounting noise. Okay, part 2. Inside the growth engine. So enough with the accounting headaches, right? Let's talk about the actual business, because this is where the story gets really, really exciting, and it all centers on one specific asset that is completely changing the game for Pampa. I mean, just look at this chart. It pretty much says everything you need to know. A 220% jump in crude oil production in just 1 year. That is not a typo. They went from about 5,000 barrels a day to over 17,000. So while the market was getting bogged down in accounting details, this is the incredible growth that was actually taking place in the business. This is the real story, right here. And, don't just take it from me. Management themselves called this out as the absolute standout performance of the quarter. And the crucial part here is that this isn't just volume for the sake of volume. This ramp-up is translating directly into strong, high-margin EBITDA. It's now a huge and rapidly growing contributor to the bottom line. Now, this kind of growth doesn't just happen by magic. They are absolutely pouring fuel on this fire. $332 million in capital expenditures this quarter alone. That's a 183% jump. And you can bet that a huge chunk of that is going straight into Rincn de Aranda to make this growth ramp happen even faster. Okay, on to our next section, guidance and management's focus. So this growth is amazing, but is it sustainable? Where do they go from here? Well, the good news is management gave us a pretty clear roadmap. And here it is. This shows that the recent surge was definitely not a one-time thing. They're targeting over 20,000 barrels per day by the end of this year, then 28,000 next year, and all the way up to 45,000 by 2027. I mean, that is a clear, aggressive, and really visible path to more than doubling production again from where we are today. That's what you call predictable growth. Now listen to this, because this quote from the CFO is absolutely critical for investors. He's saying, look, next year our earnings are going to keep going up, but our spending is going to level off. What does that mean in simple terms? It means we're hitting a massive inflection point. Right now, it's all about growth, growth, growth. But soon, that growth will continue, and the free cash flow is really going to start pouring in. That's a huge deal. And there's more good news that came out of the Q&A. It's not just about the headline growth. First, they're getting way more efficient. They expect their cost per barrel to drop by almost half as they scale up. Second, their other big business, power generation, is also said to improve nicely. And third, they're being super disciplined. They'll look at deals, but they're not going to overpay, and they're keeping their debt levels really low and manageable. It's a really solid all-around picture. All right, this brings us to the final verdict, the next call, our view. So how do we balance all of this? How do you weigh that temporary, noisy accounting item
against this just incredibly powerful, real operational growth story. For us, when you boil it all down, the conclusion is actually pretty straightforward. Look, we think the market is simply focused on the wrong data point. That initial reaction to the non-cash charge has created what we see as a clear opportunity. The growth from their shale asset is not only real, it's powerful, it's cash generative, and we believe it's being significantly undervalued right now. And for that reason, we're giving Pampa Energia an outperform rating. Which brings us to our final section, a trade idea. Now, just to be super clear, this is not financial advice. It's just a plausible strategy based on the analysis we've walked through. So how might someone position for this potential re-rating? Well, it breaks down into 3 simple steps. First, the thesis. We believe the market is making a mistake, focusing on a one-off charge and totally missing the real story, which is this incredible high-margin oil growth. Second, the trade itself. Pretty straightforward, going long the stock with the expectation that it will re-rate higher once the market figures this out. And third, the catalyst, what makes it happen. We think it's the very next earnings report. It should be a clean quarter without all that accounting noise, which will force everyone to look at the powerful fundamentals staring them right in the face. And just one final time, as always, please remember, this analysis is for informational purposes only. This is not financial advice.